Welcome.
Hey,
It's
Frank.
Frank. Hey, what's up, Andy? So you're gonna meet Andy today. As you know, you guys are here to find out why Zillow, and we use Zillow et al., all the referral providers may cost a lot more than what you think when it comes to your profitability. And Andy here runs a phenomenal uh, fractional chief financial officer business. Many of you are customers of his. Andy is also a customer of Viral Marketing, our marketing agency. And I'm here to offer some insights later in the webinar when it comes to what are some things you can do to generate business without paying Zillow in this case or lead providers to bring your profitability up. So I'll share some of those insights later here on the webinar. All right. But Andy, this is your time to shine. If you guys want to reread what you registered for, if you go back to Zoom, the invite for the webinar and take a look at the write-up, we're going to do our best to stay on track of exactly what you register for and what you're here for. We are going to cover that. And if you have any questions, we have the Q&A here on the Zoom that if there's anything you want to ask Andy, ask it, ask away, and I'll bring it up, or if Andy sees it and it's the appropriate time, we'll answer it for you because what's nice about these things is they are live and you can actually talk to both of us. And it is being recorded, so you have to peace out early. We'll have a recording out to you probably within 3 or 4 hours or so. All right. So there's our housekeeping. Sound good, Andy?
Let's do it.
All right. So I'd like to start maybe with this question. Let's get you started. I think when we were talking, we were putting this meeting together, is maybe what you hear at conferences or the speaker on stage or the webinars, and you hear about, production numbers. In many aspects, the revenue numbers, I call them sometimes the vanity numbers of
Hmm.
number of homes sold. It's easy to assume, you're making profit or an income that you can go use to fund your lifestyle in some way. That's not always the case. I'd like you to speak to that because, like I said, you have a very unique insight of looking at the profit and loss and the financial statements of clients and customers that, let's be very clear here, that you have consent and no personal names of any of these financial statements will you ever know who any of these stories are to. Correct, Andy?
Yeah. Absolutely.
Yeah. But I think it's helpful.
Yeah.
So speak to that. Why did you choose a topic for your webinar on, you might want to think twice on the Zillow spend.
Well, partly because I thought everyone kind of thought like I did around Zillow that it's um, not a great growth strategy and almost more of a profitability disease. But then I realized, wait a second, not everybody sees what I see. They do see the vanity on stage and in the webinars and things like that, and they see those vanity metrics. They don't see what I see. So I couldn't help myself but once I realized not everybody sees these numbers to say, wait, we gotta point this out in our industry. I made a post actually on Facebook that I got some hate for it and I got some praise for it. It was kind of a lot of reaction. And it was that Zillow Flex teams are really like family members who are hooked on drugs, but still somehow become the life of the party. And it resonated because I think
That's good.
yeah, I mean, it was a perfect example in my mind of like, man, why are we celebrating? And I realize that there's reasons why, and we can talk about those reasons, but I think I think it's a problem, and we've got to shed some light on it. So that's why I thought it would be a good time.
Andy, that's hilarious what you just said. And it's always funny when you say something like that, where there's always a large element of truth, right?
Yeah, both
Yeah.
sides react.
Yeah.
Yeah, both
Okay.
sides. So yeah, I mean, I think that's why we got to talk about it. I mean, I oversee bookkeeping for hundreds of real estate teams every single month, and I do see the behind the scenes, like the real, not the stage talk, right? And there's a place for stage talk, and there is, and it's not all bad. But at the end of the day, it does come down to, are we building this thing truly like a business, and do we understand what's going on? There's a lot of different ways to generate revenue from owning a real estate team. I think everybody thinks it's just from the real estate team, and these Zillow teams oftentimes they're not generating revenue from their team. It's a loss leader, and I don't think everybody knows that. And then they hear their metrics on stage, they think I must do what they do, not realizing the actual financials behind the model that they're building.
They're playing a different game.
playing
You
a
think it
totally
you
different
think
game.
it's making money with the real estate team, but it's just the front end to a different back end.
Yeah, right. Yeah. And then when you stack broker splits, agent splits, admin overhead, all of the stuff, the math just doesn't work when you're trying to build profit out of your real estate business, the actual team. And so there's just that hidden cost. And I think some people I'm seeing, even those that do make money in their team with Zillow, even if the margins are thin, they're not tracking it very closely. They don't see how much of the revenue is coming from Zillow versus from their own marketing efforts, and that can be an issue as well. And so I just want to shed light on what's actually happening behind the scenes there. So, um, I can, I'd almost want to show an example.
We should. Why don't you? So let's step this back. And I think what's interesting what Andy shared. Um, Andy, for lack of a better term, is really good at accounting, understands accounting, right? Bookkeeping, accounting, and you stare at financial statements, an income statement, a balance sheet, and you know how the chart of account works. You know how these income statements work. That's a rare skill set in general. So let's really go through and break down like what is an income statement? What is a profit loss? Can you explain it to us?
Well, sure. I mean, to me, when I look at a profit and loss, I look at it from an entrepreneurial mind, not a CPA's lens. And I always tell my clients there's two lenses in which we should be looking at our P&L. One is through a tax lens, and
Which is
that's
most.
which is most. That's what most people do books for, is for tax purposes. If you talk to an accountant, a CPA, where that's what they do, they're setting up our books uh, to look at them through the lens of taxes. It's important. We should do that. However, there's a whole other side of the coin here, and that's really that health lens. What does it say about the health of the business? When we set it up that way, our P&L really should include 5 sections. And those 5 sections help us understand the health of the business. The 5 sections are total revenue. Like before agents, broker, referrals got paid, what was the top line GCI of this team?
Before the broker.
Before everybody, what did our business generate in revenue? If you think about it, the broker is a cost. They provide value, and there should always be a return on that cost. If we're not tracking it, we don't know if our broker's worth it or not. And every broker offers different things. Some will offer office space, some will offer marketing, a brand, some will offer staff, whatever. But we need to understand what that ROI is on that spend, because it is spend. It comes out of the commission that's generated. So we need to track the top line revenue. And I see that most CPAs and bookkeepers that don't understand real estate, they don't track that because it has nothing to do with taxes. And they also don't track the second category, which is your cost of goods sold. Because again, really, it doesn't affect our taxable income at all. They'll usually start with number 3, which is your gross profit. That's what you have left as the team leader, right? We start with total revenue. We pay out cost of goods sold, which is our broker costs, our agent splits if we have a team, and our referral fees, like to Zillow or to agents that send us referrals. Then we're left with number 3, which is that gross profit. That's the amount that actually hits our bank account as the business owner. We then got to pay the actual bills, like the operating expenses from that. And that's the 4th section of our P&L. And then that leaves you with what now our net profit is, number 5. And so when we set up our P&L with all 5 sections, our business becomes visual. I look at it like a pie. The total revenue is the pie. And the first piece of the pie, there are 3, by the way, is our cost of sale. The first piece is how big of the pie, how big of a piece of the pie goes out to broker, agent splits, and referral fees to like Zillow. If that piece gets too big, there's not enough left to pay the bills and still have any profit. So that's the first piece. We got to control that. We got to understand how big that piece is. We got to have strategy around if it gets too big. We got to have a splits that allow us to hit a certain size piece so we don't get inflated there. And then the second piece is operating expenses, and the third piece is net profit. And so we have 3 pieces. Every business I work with, $10 million GCI teams down to $100,000, solo agents, all have those 3 pieces. It just depends on how big each piece is. That's what determines the model that we're building. If I'm trying to build a 20% net profit business, that means I got 80% left of the pie to split between operating expenses and cost of sale. If those get too big, I'm not going to hit 20% net. So it's always a ratio of those three pieces. And every business has three pieces currently, whether they know it or not. They have a model they are running. And then everyone should have one that they're trying to run. And the question is, how close are we to what we're trying to run to what we actually are? And we should keep it that simple. The problem with the Zillow Flex, when we add that to the equation, it takes the cost of sale piece and it oftentimes doubles it, or at least, 30% more going out in cost of sale because we're now having to give a huge chunk of that GCI to somebody outside of our team in the form of a cost of sale. It feels like we didn't spend the money because we may say, well, we never would have generated that revenue anyway. Well, no, you may have.
We never took the risk on the front end, and I paid for not taking that
Sure.
risk on the back end of getting the client.
Yeah. But it sure is a cost that I think oftentimes is hidden for most. One, because they're not tracking it. And number two, because they're not looking at those numbers and understanding. It's just like the drug analogy. When a drug is it's like any paid lead source really is almost like a drug. When it's in a controlled environment, like a drug in a hospital, like morphine. Morphine in a hospital can be an amazing tool when used in a controlled environment, in a limited dose, and for a short period of time. But when we become dependent on it, it becomes a drug that can ruin our life. And I think the analogy is exactly this. It's a real estate business.
Yeah.
So that's why we need to track it in that cost of sale. It needs to be part of our P&L. And I need to see a line item of what percentage of my revenue is coming from these third-party lead sources. And if that gets out of control, it's like me being a doctor saying, you're no longer prescribed these drugs anymore because you're taking them recreationally. We got to get away from that. So that's how
Andy,
I,
your analogies and what you're saying related to lead spend is phenomenal. I think they're great metaphors.
thanks. Yeah. It's just,
They're
it's just
strong
so true.
metaphors.
Yeah.
Yeah. Let's
Yeah.
uh let's take those five things and continue to ask your questions over here, everyone, because we're talking accounting. And there's confusion of where things go. How do we think about the money? What five buckets? All right. And we'll get to them. Put them in the chat. Let's pull up the P&L.
Yeah.
This isn't something you see on a webinar. This isn't
Yeah.
something you see at a conference. When's the last conference you went to at Inman or anything where it's like, let's go through the profit and loss statement that's been audited
Yes.
and understand it? Well, let's share one and let's see if we can walk everyone through the numbers of what here's probably someone that thinks they're doing a pretty good job, or maybe they know it, but they're making monies in other ways.
Yes.
Let's just here, let me show you how to share this a little bit. Zoom in, Andy, on that, will you? So there's no black on either side of the paper. Yeah, there you go. Perfect. So this
Okay.
is a 10 million GCI team. Will you go through the buckets and help us understand
Yes.
this business? And this is
Yeah.
just in one quarter. Is that right?
This
Yeah.
is one quarter. This is one quarter on a $10 million annual GCI team.
And scroll very slowly
You
if you
bet.
can, because it shows it's slow for you, but it's fast for the audience.
I see. And this is a team that is heavy on Zillow Flex. I would call this a Zillow Flex team. A lot of their growth and a lot of their um, leverage for recruiting and for bringing agents on is the fact that they have these leads. They have a good number of agents. I think maybe 40 or so on this team. And in this quarter,
78% buyers, 18% sellers.
yep, you got it right there,
Mhm.
right? So not heavy, at least in this quarter. I think that's a little heavy on buyers in this quarter than I normally see with this team. But um, here's the first section. Remember, I said there are five sections. Here's the first
My
section.
goodness, $1.8 million in commissions in 3 months.
Yes, right? And they have some transaction fee and some so when we talk about income, I like to break it out in our P&Ls between how much did the owner do? So you can essentially see the owner's out of production. I think this was some referral income on the buy side that they had. So they're out of production, and that matters because our net profit then needs to be higher if this owner is doing a lot of deals.
Or they could be paying themselves a commission on their own deals, but you're just
They
informing us they're
could.
not, that there's no seller earnings, there's no owner
Correct.
earnings in the buyer or listing income.
Exactly. So then we look at, well, then how much just came from their agents? the majority, 99%. So this is basically an owner out of production team.
Okay, they're making a ton of money, Andy. Look at all this commissions
Yeah, in one quarter.
in 1 quarter.
One quarter. It's crazy.
Yeah.
So now let's look at where the money went.
All right, so
Remember
this
I
is the
said,
second. This is the second bucket. Explain to us cost of goods sold again.
yeah, right here. And it's a little bit bigger category. You can see it's not huge, but it scrolls down all the way to, and I'm going to go back to the top here, but it goes all the way down to here, total cost of sale. So they generated 1.8 in this quarter. Their cost of sale was 1.265. So 68% of the pie, going back to the pie analogy, was their first section, that first piece of the pie that got cut out. So they didn't see 1.8 million hit their bank account as the team leader. They only saw 590,000
So
of the
let me
1.8.
so let me ask you here. So on the buyer agent, the blended split to all the buyers, depending how they're compensated, was 38% of the commission. Is that correct when I say that?
It was 38% of the total revenue. When I look at that, so here's what you got to look at a P&L is you got to understand how to break that out. So what you're asking, Frank, is on average, when they do a buyer deal on their team,
Hmm.
how much do the buyer's agents keep versus
Yes.
the team? So what we need to do is take 711,000 and we divide that just by, I don't want to get too far off here, but just only, by the buyer income on just the team side.
Even I made a mistake there.
Yeah, so
Yes.
1,449. And that tells us our average buyer cost of sale, and it's 49%.
Okay. So it's about 50-50.
Yep, on that one. Now we could do the same thing on the listing side. This is why we set up the P&L this way, because when I see the cost of sale getting too high, I would immediately want to go to, is it a split issue with the agents? Even if our splits are good,
Yeah.
if I
See,
see
yeah.
that
See, the 6%'s not right. So you got to take the
that's not
116
correct.
divided by
The total
listing. So
revenue
what are
on
our
the
listing agents
side.
making as a blended payout of cost of?
30, 36.
It's pretty good on the listing side.
That's really good. So here's the deal. If we, I don't want to, we may come back to this because when we look at cost of sale, there are typically only three things included in cost of sale for the most part. Broker costs, and that was just on the owner deals, but broker costs, agent splits, and referral fees. If I see that cost of sale is too high, in this case, I think it is too high, depending on the model they're trying to build.
Here,
At,
Andy,
at
sorry,
six,
zoom out a little bit so we get more context on the P&L. Just from the, yeah, there we go.
yeah. So 68% of the pie went out in cost of goods sold. And if that's too high, all I have to do is go and look, did I pay the broker too much? Did I pay my agents too much? Or did I pay too many referral fees? And so we say, okay, we look at the broker. And in this case, the broker was very inexpensive this quarter. They probably capped. And so they don't have a ton of broker fees. Great. They just have some transaction fees around the broker. Okay. So
Very,
green,
very reasonable.
it's not the broker. Second, we can say, well, is it the splits with the agents? I can say on total, I paid out 848,000 to my agents on just the team owner commission, 1.843, including some referral come. So
And the
divided
agents
by
are, and the buyer's
1.843.
agents are 50-50. That's pretty par.
Right. So we know it's not
And
our,
listing splits great.
yeah, so we know it's not the split. So then the only other place we can go is those referral fees. So when I go to total referral fees paid out, here we go. Here it starts to show up. 18% of the revenue went out to referral companies in cost of sale. That's our issue. If I were to diagnose this business, I'd say your profit may not be where you want it to be because 18% more went out than probably should have because we are relying too heavily on these third party lead sources. So strategically, we can start to shift more towards company generated leads. I'll tell you, when I've had consults with this company, we've identified that what happened was they had a sales manager who wasn't doing a good job holding the agents accountable. And so they were getting more and more fed this drug called Zillow, and they would just scrape the easy deals off the top, but it had a huge price tag attached to it. So they were paying a sales manager to hold them
The
accountable. And
sales manager was cherry picking the leads from the very agents.
not that, no, no, no. What I mean is the agents were doing that because nobody was holding the agents accountable to
Mhm.
working the company leads that they were generating, right? The agents
Got it.
just got spoiled
Yeah.
with these Zillow deals, but it eats away at the profit. And so that's cost of sale. We have to understand the total cost of sale. And if it's too high, we dig in and we say, is it the broker cost? Is it the agent splits? Or is it the referral fees we're depending on?
So 68% of the money is out the door before you have to pay all of your real business expenses.
Correct. So then that's the gross profit. That's the amount that hit the bank account to this business owner.
590,000 the first quarter after it all went away.
Yep. Well, that's what we have to work with. We got
I'm just
590 grand left.
I am curious, how much delay is there from a closing? Does Zillow get paid right on the closing document?
Yeah.
Or is there a bill set later where you have like 30 days or 60 days or 90 days to pay? I don't know.
No, I don't
Anyone
believe so.
know?
No, I'm pretty sure from what I'm aware
Right
that
at closing. So they get the
correct.
money. They're in a higher position than you on the money even.
Yes.
Got it.
Yeah, which by the way is another reason why CPAs don't track it in the books. We actually go to the closing settlement statement, find the total revenue and the amount that
And
got
add it
paid to
back.
Zillow and add it back in. We
You
need to
know,
account for this stuff.
let me share with you for those of you guys looking for a good accountant, what Andy just said there of going back and making, I believe it's called journal entries, of organizing these numbers so they're understandable because the money was taken out before the money hit your bank account, as well as you're probably getting your commission check after the broker has gotten paid,
Yep.
right? Or maybe your check is sent to you personally and you cash it, but you don't run it through the LLC or the business that you're running. Someone has to go back and clean up all that to help you make sense of these books, and they really got to understand and put the time in. And you do that, Andy.
Absolutely, because that's the other side of the coin I was talking about, where we have to understand the health of the business, not just our tax liability in our P&L. And if we don't track those first two sections, total top line revenue and cost of sale broken down in a very simple format, then we don't know we have a problem. It looks like we're making money, but our revenue is, we may say, well, this is what when I go to a real estate conference, I hear somebody on stage say, I have a 40% net profit. I'd say, okay, on what number? 40% of what? Your gross profit or your total revenue? How much production are you doing? Are you paying yourself like an agent? Like, we're not even all talking the same language when we talk net profit margins because we aren't tracking the right numbers and looking at what we call our adjusted net profit, which takes into consideration what you would have paid an agent to do your deals
Yeah.
if you
Taking your own pay.
aren't. Yeah. So, anyway, those are the first two sections.
Let's go down to expenses. Let's take a look at the marketing. Now you not only do you have the Zillow marketing now, but now probably the next tier of expense is all the other marketing expenses to generate leads for your agents, not just Zillow.
Everything
There
else.
you
Now,
go.
the good news is in this case, we break in our P&Ls, we
Hey,
break expenses.
so you're sorry, slow down on the scrolling. Just keep it right there.
Okay,
It's really fast for us on the other end when you do that.
you bet. So the first category is lead generation and marketing. That's the first category of expenses in our P&Ls. I want to see just three main categories: lead gen marketing, people, and overhead. I think a lot of teams are around that we work with are shooting for 30% expenses, around 10% in each category. That way I can look at each category and say, are you close to your goal of 10 or 12 or 5, whatever the goal is for that team? And then if we're above, let's say the goal of this team was to be at 5% lead gen marketing expense. I'd say, great, you're there. We don't need to go and critique your expenses around this category. If they were at 12% and the goal was 5, I'd say, hold on, you're leading with expenses, not revenue. We need our revenue to be there before you're just spending all this money. Let's go in and figure out, is it internet lead gen? Let's dig into that category and see all, there's other reports we can
That,
see
is
every
that paper? Is
individual
that
lead
pay per
gen.
click, Andy? Mostly pay per click ads, you think?
Internet lead gen probably is, yes, for
Yeah.
this team. Yep. And it could be different things. There's different vendors that are included in there. And a different report would show every individual vendor
Yeah.
separately. On this report, I like to see. So in this case, they spent 5%. That's not bad on lead gen marketing. Now let's go to the second category,
Staff.
people. And that one is going to go from there all the way down to here. Total, they spent 18% on people. Now, I wouldn't be terribly concerned with that depending on what their plan was. If they were, you know, because they're 5% low on lead gen marketing, if the goal was 10 and they're only at 5, their strategy may be, I'm going to spend a little less on lead gen marketing. I'm going to spend more on people. And so I'm okay with being a little heavier on people, but whatever. We just want to know what the goal is as a percentage of your revenue and whether we're on or off track. If they said the goal was 15, I'd say you're a little heavy on people. You can't be adding any more staff people right now. We can't be
I
offering
I
salary
think
raises.
I think when I look at this, they know that. And to spend $33,000 on foreign labor in 3 months, that's this individual knows how to use foreign talent, and there's more capital going to be pushing there for sure. That's a lot of money on foreign labor
Yeah.
in three
Yes.
months.
Right. So we would dig into that and say, is there ways we can
Well, it's
hold our
good. I mean, that's
people more
I
accountable?
yeah, but that's a
And
good VA budget.
the final category is overhead. And overhead is everything that isn't a lead gen marketing dollar or a people expense. It's just everything else that we spend money on. And so there's a number of categories in here. But if we scroll to the bottom, we can see the total for overhead. They spent 14% of their revenue on overhead. Then it tells us the total of all three categories, 37%. So if you remember, we started with 100%, we paid out 68% in cost of sale, then we spent 37%. That's a problem because what does that leave us with? A loss. We spent more than we had this quarter coming into the business in gross profit. So I think a couple things we can take from this is if I was this team and I had a loss and I wasn't planning to have a loss, I would say there are two places we need to go digging. It's either expenses are too high or our cost of sale is too high. It's one or the other or both. Every time, always. Either we spent too much or we gave too much away. And in this case, I would say it's both. I think most teams should be close to that 30% expense model. They're at 37. We know lead gen marketing wasn't the problem. Overhead at 14 and people at 18 tells me we are overspending on people and overhead. We're spending on stuff that we need to be careful of, and we're spending on people that aren't bringing in the revenue that we should see based on our spend. So if I was them, I'd be going deep on those two categories and figuring out where's the waste. Let's get back down to 30%. That, if you remember, we're at 37%. So I just found 7% in profit that got overspent. If I applied that to the profit, if I fixed it and applied it to the profit, we'd now be a plus 2% profit because we were a -5. We overspent by 7. We're now a plus 2 if we had fixed that for next quarter. Now, I'm still not happy with that. A 2% profit is not exciting. So then the only other place to go is cost of sale. And again, going back up to cost of sale, I know this is fast, but I want to get up to cost of sale. We were at a 60%, 68% cost of sale. If I want to find 10% in there, I have three places to go. I either need to look at my broker costs, my agent splits, or my referral fees. In this case, broker wasn't too expensive. We know that's not a problem. Our splits, we already calculated, those were both under 50% and an average of closer to probably 42%. So the only other place we could be off in cost of sale is referral fees. And of course, when we go there, guess what? There's the missed profit right there. 18% going out, specifically 14 to Zillow, 14% going out to Zillow. If they want to fix their problem, they've got to cut their expenses to get closer to 30%. And we need to get our Zillow dependence down. There's a number of ways we can do it. But that's to me as clear as day when I look at this P&L. If that's why we were not profitable, is those two specific reasons.
This is wonderful. Feel free to ask your questions. We'll get to these. Question I have that I think maybe the audience would ask. First is, what about add backs to the net profit? So you run your nice car through there. Maybe you're spending $100,000 a year on the coaching program.
Yeah.
Maybe you're going to Vegas for all the trips and staying at the Wynn.
Mm-hmm.
Whatever it may be. Do you ever do like I think it's called seller discretionary earnings calculation of like if you add back all the other benefits up below the line or above the line to get a
Yes.
true what is the owner full financial benefit versus like you said from the tax standpoint? What are your
Yeah.
thoughts on that?
100%. We call them indirect expenses. So there are direct and there are indirect expenses in your P&L. Direct are the true business expenses. The indirect are any expense that we're running through the business as a tax strategy. We're decreasing our revenue on paper to make it look like we made less. in order to show a lower profit to pay less in taxes. That's a great strategy. But yes, we need to separate those out. We use a simple tool in QuickBooks called tags and classes where we
Got
just
it. That's how you do it.
separate those out. But it's a great point. And it goes back to that adjusted net profit, ANP. I preach this with everybody any chance I get. ANP, adjusted net profit. It's not like a term that like we kind of made it up because we realized there's this problem that real estate agents look at their P&L, they see a percentage of profit, and they say, "Oh, I have a 20% net profit margin. I have a 60% net profit margin, whatever it is." But they're not adjusting, and we're not all talking apples to apples like I said before. Somebody on stage says they have a 40% net profit and we think, "Oh shoot, I only have a 20% net." Well, maybe you are paying yourself like an agent, they're not. Maybe you're in production, maybe they're not. Maybe you pay yourself a huge salary for a tax strategy and that's included in your operating expenses, but it's really just profit that you paid yourself in the form of a salary. So the person on stage doesn't do that. Their net profit looks higher. We're not talking all apples to apples. Same with those indirect expenses. So there's actually a formula that I think is super simple that you need to run if you want to know your true profitability, not from the tax lens, but from the health perspective. It's called adjusted net profit. The formula is super simple, I think, but I do this all the time. So I realize it may be a little complicated, but it's not. It's your net profit on paper. Scroll down to the bottom of your P&L, look at your net profit on paper. You then are going to subtract from that number what we would call unrealized owner cost of sale. Most of you are not paying yourself like an agent on your team when you do a deal. And so all that money goes into the P&L and it looks like it pads your numbers and it makes it look healthier than it actually is. So your unrealized cost of sale is what you would have paid yourself or some other agent on your team to do those deals that you did. If you're averaging a 50-50 split and you did $200,000 of GCI yourself, your unrealized cost of sale is $100,000. So we take our net profit on paper, we subtract that amount. Then we add our owner's salary and we add any indirect expenses we're running through the P&L. That's the formula. So it's profit on paper minus any unrealized owner cost of sale plus any owner's salary plus any indirect expenses we're running through the business. When we do that formula, that's the true amount of money our business made from a health perspective. If I was going to come buy a real estate team, that's the number I'm looking at, not what your accountant put on paper, because that's a tax number. This is a business health number. And then you divide that dollar amount that you just calculated by your total revenue, and it tells you your actual profit margin, the percent. That's the true margin in your business, not what you see on paper. So, for example, let's just do that as an example. This person had a loss, $93,000 loss. Let's go back up to the top. Sorry for the fast scrolling. Now, they didn't do much production, 11,592. But let's just say they didn't pay themselves a split on that, and they actually did those deals. And let's just say their average cost of sale when they pay an agent is 50%. We take that and we divide it by 2. That means they would have had another $6,000 in cost of sale that's not showing up in this P&L on their production. So we would take the loss that they had of 92,722, and we would subtract another 6,000. That means that we're now at 86,722. We would then add any salary that they paid themselves. Let's just say they paid themselves $100,000 in salary. Then we're going to add any indirect expenses. Let's say they spent, I don't know, $50,000 or even $25,000 on indirect expenses. So we would then add $25,000 in expenses. So we would essentially have, even a bigger loss. So if we did 90 to 722, minus, and then that would be a loss of 6,000 minus 100,000 in salary. So that's a loss of 1278 plus 25,000. This business actually, if we do the adjusted net profit calculation
Hmm.
and everything I said was actually accurate, I just pulled those numbers out of my head. They would have had a $24,000
Profit.
profit,
Yeah.
right? So that adjust, if you all do that exercise, you'll see what you actually made in a net profit from a health perspective.
I posted in there, I think I was taught, if you want to Google seller discretionary earnings is another way of thinking about adjusted net
Yeah.
in some ways. Let me ask you this, and this is wonderful. Thank you so much for sharing this. And I hope this is really helpful for everyone to kind of interpret a financial statement. Really, another question the audience I'd like to ask you is, does it matter? You got Zillow leads coming in, you can recruit to it easy. You're obviously doing business, you're doing 10 million GCI. You know, is the goal to even make money on the real estate team, or is this really just funding something else? And how do you account for that? What are your thoughts on the back end to what this front end is creating for the owner of the business?
Um, Obviously, it depends on what kind of business model you are building. For some of these teams, it is, um, there's a purpose behind building the way that they do, which means that their business doesn't really make any money. The team doesn't make any money. Sometimes it's ancillary businesses that then make the profit on the back end because of the high volume of transactions that they're doing. So mortgage, title, insurance, whatever ancillary businesses they may have. Um, Sometimes it's revenue share. I'm seeing that a lot, right? They're using this business to build their downline. Wonderful.
Because there's no JV income. This isn't a holding company from the JV income from the title and the mortgage going into this. And I don't see any
No,
revenue share coming in from the revenue share profit sharing brokerage at the top, right?
correct. And if there was, and in fact, this business did have some, and we put that below the line as other income. It's not on this report, but you would see all this other income that would then show there. We separate it from the business income because then otherwise it skews all the numbers of how healthy their real estate team is. And so we separate that as other income and things at the bottom. But yeah, that's how some people, but the problem is other teams that don't know that and they don't realize their team is running at a loss will follow their lead and say, "Oh, I need to get Zillow." And it's a great opportunity. All the while they don't realize they're not making any money, on that team.
Last question, then we'll move down. The
Yeah.
balance sheet, assets and liabilities. When you're running a $10 million a year machine, you probably go into the balance sheet of debts and cash. Where does that team need to be from like access to emergency capital amounts if something goes wrong carrying
Yeah.
that kind of responsibility?
Well, I suppose it depends on how much risk tolerance the owner has. And personally how reliant they are on the business. I mean, to me, I was actually thinking about this yesterday on a walk I was on. I was thinking, why can some people afford to take huge risks in business and others can't? And it really comes down to their being insulated to that risk. A team like this, in my opinion, with $683,000 of expenses, like kind of fixed expenses, um, better have, in my opinion, 3 to 6 months of cash to cover those expenses, depending on how much risk they're willing to take. Where people get in trouble is they don't. Then what happens is the bills stay the same, meaning every month they still got the same amount of fixed expenses, but they don't have the revenue to cover it because we all know the market can do this, our team can do this, income does that. What I see happen is then the owner has to either get back into or double down on personal production. And then all of the revenue from their production goes in to cover those bills and expenses just to keep the lights on. And it's not fun to watch. But if they had had that cash sitting there, if they had been saving and having those reserves in there, that wouldn't happen.
Yeah.
Because when it happens, Frank, they get sucked back into production. No one's leading the team.
And I'll speak to that from anyone that's built larger businesses. It's like, oh my gosh, we're making money. I'm finally profitable. There's money in the account. And you've been working from the moment you wake up till you go to sleep and you built this wonderful thing. only to realize you just have to sock more and more of it away into savings to offset the risk that you've taken to build a business this large.
Yeah.
you know? So it's like it just takes so long to get the financial benefit. And if you pull that cash, net operating, income out too quickly and you can't withstand the storm, the whole thing comes crashing down. All right, let's go on. I see you have a 2 million team. I think what would be
Yeah.
interesting is you want to share that. There's a little bit different there. Huh? That's probably a little more relatable.
Yeah. A $2 million team. This is a 12-month P&L. So the whole year they generate about 1.878 of income. And you can see kind of the same thing. The owner's not really in production. And so the team did the majority of that revenue. So that's good to see in the sense that that means our cost of sale truly is the true cost of sale because we don't have a bunch of owner income padding the numbers. Um, you can see again, broker fees, commissions paid out to agents and referral
Same,
agents,
same general split 50-50 when you do the calculation
and
and
then referrals. I didn't do it on this one, but let's just see. $592,000 paid out
divided
to
by the
buyer's
buyer
agents,
income, not total revenue. Yep.
correct? Just divided by the 1,329. 45% on the buy
Okay.
side. That's
Great.
good. We're
Yep.
under 50 there. On the listing side, 183 on 425.
Good.
43%. So not bad.
Great.
A little high in my opinion on the listing side. It's not bad, but typically we're going to make more money on that listing side because we can offer more leverage to the listing agents through staff and systems. So there's usually a higher profit margin on the listing side. If anything, I'd pick the agent apart a little bit on those listing splits. Chances are this person is referring too much on the agents to generate the listings versus the company. And he probably has two different splits, an SOI and a company gen split. And we just have too much of a ratio of agent SOI listings when we need to shift back to company gen listings so that we don't have to pay as much out on every listing because we're covering all the cost of all the listings.
What's a
Marketing,
company, what's a
staff.
company commission on a broker fee? I mean, you paid the broker for a deal.
Say that again.
What's a company commission?
Well, oh, right here, company
Yeah.
commission. I'm not sure what that would be. I'd have to dig into this
Okay.
specific client. I
Fair
don't,
enough.
but it's part of some of the broker costs of some kind.
Okay. All fine. Referrals paid. Let's look at that.
Yeah. So
Oh my
then
goodness gracious.
referrals fade 23% of the revenue going out to Zillow. 426 grand Zillow made in this year off this team. And let me just scroll all the way to the bottom quick because I want you to see what the team made. 100 grand. Zillow made 4 times more money than this team leader, and the team leader did all the work.
I think Zillow looks at these and is like, I don't think we want to get in the team business. Better
They,
off taking the royalty.
yes. Yeah. And you can see the expenses weren't on. It's not because this person was over on expenses. They only spent 26% of their revenue on expenses. So remember, it's always cost of sale or expenses. Expenses isn't the issue. We go back up to cost of sale. Their total cost of sale was, again, 68%. It wasn't broker costs. It wasn't agent splits. It was Zillow. And so, most people on this call could make 100 grand by doing production in their sleep, doing just a handful of deals. This person ran a big team doing 2 million and made 106K net.
And even with all the add backs, maybe 150 for your, you said the
Probably at
net
best.
nested,
Yep.
net,
Yep.
net adjusted profit, right?
Right. There's not a lot of ad backs in here for this person. So, a little bit.
Okay. So this is really fascinating. And again, I would assume for your clients, do they know this and then are they fine with it because they're playing a different game? I'm really curious.
Some are, yes. And that's all I care about is that we're clear on the strategy. What I'm trying to help people see though is that when you go and you listen and focus on vanity metrics, agent count, top line revenue, deals, all these things, we're not seeing what's going on, what we just went through. And then we start doing the things that they're doing, like buying Zillow leads and just throwing money at paid leads without tracking ROI, all this stuff, thinking that it's going to get us what we want. And then we get what they have, which is a business that doesn't make much money. They're fine with it because they make money other places, but you're not going to be fine with that.
All right.
So that's the problem.
So here's a team making money.
Zero
Uh,
third party lead, zero third party lead expense. This person has a past client database killing system, right? Like they kill it with maintaining
All
relationship with
right.
their past clients.
Rename viral past client database killing system. I like
Yeah,
that. Good.
there you go. So this is a 12-month economic P&L from it's a very much more simple format here, but same idea. They made 29% net profit. Now, before I show you the numbers, I put this in here because this is the key right here.
And Andy,
Owner hasn't sold
zoom
a
in a little
home
bit.
since 2018. So they're not padding the numbers with their production.
Andy, real quick, zoom in so the text hits the edges of the screen.
Yeah. A
We got to go little farther. A little more. One more.
little
One
more.
more. Yeah. There you go. Thank you.
Okay. So owner hasn't sold a home since 2018. So it's not like they're padding their numbers with their own personal production. The owner pays a full-time CEO in these expenses. So he doesn't even have an office where his team is. He meets twice a month with his CEO for 45 minutes. He told me he spends about 58 hours total in this real estate team business. He has 5 other businesses he runs, and his profit per hour is 18. He calculated 18 grand an hour. So like this is a real this you wouldn't even know this person if I told you their name. Like they are under the radar, crushing it, not talking about number of agents, all those metrics. They are focused on profitability. And here's what it looks like. 3.8 million in total revenue.
At that zoom 2 more times.
Is it really that far out for you?
Yeah,
Okay, now you can see it.
that's
That's as
good.
far out in as I can go.
That's good.
3.8 million in total revenue, GCI, top line. Agent costs of sale and broker costs of sale. By the way, he also owns the brokerage, so that money goes to him, the owner, by the way, as well. But anyway, uh, then then it leaves, he's got some bonuses in here and he includes his listing costs in here. So his gross profit was 55%. So his cost of sale was 45, he was left with 55. Then he had to spent 967,000 over the year to run the business, which is a 25% expense model. And he was left with 1.1 million in net profit at 29%.
Goodness gracious. So
Yeah.
break it down for me. Just step back from the numbers. Unshare your screen. What does someone have to do to go in that way to get that? How's there? Just give me a little bit more better idea of like you know this individual and how they run their business. What
Yeah.
advice do you have the audience that wants that third P&L?
Hmm. They have to be good at I mean, essentially he owns the marketing. That's a big piece of it. It's not the only thing, it's a big piece of it, meaning he doesn't rely on other people to generate business leads for him, like Zillow, like others. They have relationships with the database, their past clients, and those types of things. And he doesn't leave that up to the agent to foster the relationship with the client. The team maintains the relationship with the client. It's not just the agent. And I think that's a key perspective as well. He is a little heavier listing side than buy side. And the majority of the listing opportunities are generated by the company, not the agent's SOI. If we rely on the agent to generate these deals, we typically got to pay a higher split. And now all of a sudden, it's like paying Zillow. We're paying too much out on these deals, and there's no money to be made after we pay expenses. He owns the marketing. They generate listing opportunities. They can pay the agent a different split, a lower split. The agent loves it because they can literally just show up for the listing appointment, negotiate the contract. Everything else is handled by the admin and the staff and the systems. And they can maintain a higher gross profit and therefore a higher net. So listing,
And you said it's no office space,
well, there is office space. He doesn't have, the owner of this team doesn't even go into he doesn't even have an office
but
in
there's
the
an office
office.
expense though.
There's an office expense,
Okay.
sure. Yep. Yep.
What about
That's
staffing?
list
Any
expenses.
insights on the staffing charges?
I don't know. Well, his people expenses were 594. That was his biggest expense, right? So 594,000 divided by 3.8 million in revenue is 16% of his revenue went to staff. So that's his highest expense point. So he has highly leveraged agents by spending on people that can leverage those people and systems. The other thing unique about this person is they run the exact same, they do not chase shiny objects, meaning they are using Google Sheets and spreadsheet. Like of course they have a nice CRM and all these things, but all their tracking has been the same for the last 10 years. They don't just move on to the next crazy piece of technology that's guaranteed to make us successful. No, no, simple and steady. And they've been doing the same thing for over 10 years. Everybody wants it today.
I absolutely love this. I mean, I think that one of the coolest things you get to see is, man, this is really what everyone wants. But it's quiet. It's quiet wealth.
Yep.
It's like stealth wealth.
Yep.
And you get to see the behaviors of the customer, like how they behave, and you get to see how they think. And you start picking up on the character traits of the individual. And that's where like the real knowledge, I think, for me would come from on this. I find it
100%.
very, very fascinating.
Yeah.
Um, Let me just take a minute for you guys. Obviously, Andy's a client of ours, and I run a company called Viral Marketing, if you don't know. Yeah, own the marketing, right,
Yep.
Andy? Build relationships with the database.
Yep.
Don't rely on that to somebody else. And then you, as the team owner, is doing the marketing, probably publishing, whatever, sending stuff out, taking responsibility for it. And hopefully those opportunities come your way. And then maybe you have a call with them, you talk to, you hand it to your agents, right? That's kind of the two things you shared that makes this individual unique.
Hmm.
You know, one of the things I can offer everyone here, this is our website, Viral, okay, is one of the things you can start doing to get going on this for those of you in real estate. I'm going to pull up some of the topics. Like these are the videos that you want to start sending out to the database so people spend time with you and get to know you and like you much how you're spending time with me right now and Andy right now. So ultimately they warm up to taking a phone call with you to discuss what you're going to hand off to your agents, just like Andy said. This wasn't prepared, by the way. I was like, man, you nailed it on the third one. It's exactly what I expected. But the real driver is you can get all the likes and the shares and the vanity metrics of likes and views and YouTube and everything. But what we specialize in, what makes Viral a little bit unique, is we have a very direct response advertising component to our system versus just building, let's say, a YouTube channel or making a bunch of YouTube shorts. You want to pick a good lead magnet every single month that actually turns that attention into leads. And these are the lead magnets that we suggest that you run every single month. And one of the reasons that I'm here is to first share with you, there's the content to start publishing, to get business and to position yourself as the expert with the database. If you'd like some help with that and you're interested in maybe sending out a lead magnet, it'd be a seller workshop, free home value. What are some good ones that you come up on your top of the mind, Andy, that generate leads in real estate?
Yeah. First time buyer stuff, like all that stuff. I think focusing on the seller side is huge for sure.
Yeah. We'll send a free lead magnet out for you and generate some leads from your database at no charge. And there's the deal on that if you're interested in working with us. Andy, let's answer some questions.
Love it.
Jonathan, hey guys, thanks for putting this on. COGS, cost of goods sale. Can you clarify that is what we pay our agents team split plus brokerage fees? Are you saying paid lead source is also a cost of goods sale or more of an operating expense? That's a good question.
This is a good question. And here's here's the answer I have is that it doesn't matter where you put it. Honestly, it doesn't matter where you put it, but that you have a plan around where you're putting it. So, for example, if you put a paid lead source up in cost of sale, great. But then you need to make sure that you understand that that changes your goal around your cost of sale margin. Same with your listing expenses. We have some teams who like to see all of their staging, photography, all their listing expenses up in cost of goods sold. I look at it as an operating expense. It's a marketing expense, lead generation and marketing expense. But some people want to see it in cost of sale. It doesn't matter, but we just have to understand how that changes the pie, how it changes each piece of the pie. And we need to have a plan around our pie. So, as far as, you know, a definition you can use is if it's paid at closing to someone else, a broker, an agent on your team, a third party, it's, by definition, a cost of sale or a cost of goods sold, um, more than it is an operating expense. Um, On that point, though, here's where I see people get in trouble with Zillow. There are some markets, and it's becoming fewer, but there still are some where they don't have the Zillow Flex arrangement yet, where they're charging you a percentage of the GCI at closing. Instead, they're just charging you a fixed monthly fee for leads, just like any other paid lead source. Here's where I see people get in trouble. Let's say they're spending $10,000 a month on Zillow paid leads, and it's a fixed $10,000 every month, but they pay nothing to Zillow at closing. And then Zillow calls and says, guess what, Frank? It's time to switch. We're putting you now on the flex. No more monthly fee, but you're going to pay at closing. Here's the mistake people make. They see their expenses under lead gen marketing drop by 10 grand and they think, I can go spend 10 grand now because I don't have to pay Zillow that money. But it actually gets paid out on at closing in the form of a split to Zillow, a referral fee at an even higher amount. So now we end up spending more in our operating expenses and paying Zillow at closing, and we wonder where the profit went. So just be careful in that transition period that all we're doing is taking it from operating expenses and putting it into cost of sale. We need to make sure we don't just replace that in more spending.
Great. When did you fall in love with accounting? To know that answer that question that way. I'm
I
almost like,
think
dude, I think I'm good at this. I think I like the language of business.
that's a great question. I don't know that there was a moment. I think over the course of building a real estate team, I'll tell you this, there was a moment in my real estate building career where I was driving my kids to school. I had two boys at the time. We have four now, and they were 5 and 8. I had a phone call come in. I was taking them to school. That was my time to talk to them and hang out with them. My 5-year-old was telling me about to say something he was excited about at school that was going to happen. I pick up the phone because the deal was falling apart and I knew it was. And I picked up the phone. I said, hold on 1 second, Grant. Picked up the phone. I hear my 8-year-old tell my 5-year-old that whatever I was doing on the phone was more important than what he had to tell me, because that's what I trained my 8-year-old to think. That moment, this was probably 2013 or something. I said, I have to get this thing figured out. I have to build this business in a way that financially can run without me, which means I need to start to understand my numbers. And I was a limousine driver before I got into real estate. I do not have an accounting degree. I don't have an accounting background. I have a entrepreneur's background, and every entrepreneur needs to understand the story that is being told about their business. And I find over and over that they're not being told the right story. They're being told what the tax story is. They're not being told what the business health story is. And it can have those conversations in those cars with our kids, be much more attentive when we have control of this business. So that's where the passion around it comes from now.
It's cool, man.
Yeah,
Sharing that.
you bet.
Couple more questions. Al says here, good to see Al. Cola Banker was one of the first drug dealers selling agents referrals at 40%, but they were not leads. They were teed up to buy corporate relo. I think it's now 40%, but they're not like teed up on a corporate relo type of buyer.
Right.
On the so it's a little more. They're expensive leads for probably a little lesser quality on the drug, so to speak, for the metaphor. Jessica says, what is, for this team, what does quarter 2 and quarter 3 look like? Do you maybe because there's fixed costs, does that make up later in the year, or
Totally.
how does that work when you look just maybe at the first quarter? What would that project to the rest of the year, let's say?
Yeah, it depends on that owner. Here's what I find is, yes, every team has seasonality, and we need to be budgeting and looking at our numbers by the month, by the quarter, and by the annual totals. And we need to consider the seasonality of any market. Um, what we have to be careful of is this idea that we should lead with revenue. And that's where I see people get in trouble. They say, well, I'm going to spend first, which will decrease my profit for now. But once I start growing, then I'll make it up on that side. And what happens is we start growing because we spent more money, like on Zillow, like on other paid lead sources, especially, and we do more deals. But then what happens? We need more staff. We need more office space. We need more stuff. And expenses don't stay the same. We tell ourselves that they're going to, and we tell ourselves we're going to be disciplined. I've now spent in order to grow. Whenever I hear that, I say, hold on. rarely do people not just keep spending as they grow, and the profit margin never changes, even though later in the year we may see that growth come. So I think to Jessica's point, she's talking more seasonality. Okay, I can understand that. That in quarter one, maybe we're in a market where the seasonality is a little bit lower. The market's going to be lower. It's winter, whatever it is. But that doesn't excuse the fact that, for other markets, that's not the case. And they're just spending before they're generating revenue. I'm a believer in revenue first, then that gives you the permission to spend. Don't spend in hopes that revenue comes later.
All right, Andy, it's tax time. People might need your help. What's the next step?
Well, for some people, they've got a great bookkeeper and they just need a better way to manage the books in a more real estate specific format. So I just put in the chat, you can download our chart of accounts for free. Use the one we use. Take it. It's the one I just showed you. It is the most simple, but uh, but looks at the entire business, and that's why I designed it the way that I did. And so you can use it. Take it. Of course, you can visit us at simple-numbers.com if you want to schedule time to talk about us doing your bookkeeping. We'd love to talk to you about it. But that's something you can do if you feel like you don't have a good bookkeeper in place. Um, and then we can always talk about actually, fractional CFO, which is where I step in and work with you every single month to make sure that you're seeing the holes, the profitability holes and the leaks in your business. So,
It's wonderful, Andy.
yep,
We put them in the chat. Oh, you put the repost those
just to
links,
you.
Andy,
Sorry.
to
Yep,
everyone.
you bet.
And maybe sum up what's your relationship with me and why do you work with us? What would you say to a team that's thinking about using viral? Might be a
Yeah,
good
for
idea.
sure. I mean, the reason I like to work with you so closely is because I've worked with you for, I mean,
Yeah,
it's probably
it's been our
15
whole career.
years, my whole career in real estate. And I saw the impact. It is, I've always told people it is the best ROI spend that I have ever spent on marketing in my real estate business and now in Simple Numbers because you're efficient. Your systems, your people, your process is very efficient, which allows you to do a ton for people at an amount of money that it's like a no-brainer. So that's part of it. And it allows me to stay in control of the relationship with my clients, whether it's in when I was in real estate or now with Simple Numbers. So, and then I think just your guys is I will say this, Frank, your culture is different than I've ever seen in that, like the lead magnet you just shared with everybody, you literally continue to just offer more value than
Yeah.
I would expect. So,
Let me share a lead magnet with you guys. We'll do just a few minutes of overtime really quick. So one of the lead magnets we're doing for our clients this month is a seller webinar. I'm sure, Andy, you would love your customers to send out cheap marketing to get people on the webinar. People want to sell their house for listings that is with the team owner, right? So they would do a webinar. Let me play like a little example promo video if any of you guys are interested in this to go execute. And again, we'll do this for you for free. I'll play this real fast.
Attention Arizona home sellers. If you're thinking of selling your home, but you're not sure if it's the right time because the market feels softer, interest rates are higher, and buyers are negotiating harder than ever, these are all valid concerns. Don't worry, I've got your back. I'll show you how to sell your home for the most amount of money in the least amount of time with minimal headache. That's why I'm hosting a live virtual home seller workshop. We're going to cover everything you need to know about today's market conditions, how to avoid pricing and preparation mistakes that can cost sellers thousands of dollars, and most importantly, how to sell your home with confidence in an ever-changing market. All of this and more, click the link below to register for this webinar, and I look forward to seeing you there. Attention.
So Kevin was just like, I'm all over the place. I'm doing all this one-to-one to one-to-one to one work from the moment I wake up to when I go to sleep. What can I do here to like keep profitability high, get listings, hold the relationship? I was like, let's go a little more one to many in the way we're communicating what we're doing now, Andy, right? You guys are on a webinar. This is what they're like.
yep.
So he shot this, we put it up on a landing page, and then basically after some promotion, 34 people submitted their names, phone numbers, and email addresses. He talked to them, pretty much got him excited. Now he doesn't have any agents, but wouldn't that be great if he could hand them down to his agents to go work for? What split would you suggest he pay?
I mean, 30 to 35%.
Okay, 30 to 35%. So those types of marketing activities, when you can put out messages online through email, maybe even some light retargeting, where it drives people to consume you as the team owner to build that initial front of the relationship that then you can hand off, I think is really exactly what you were sharing with the guy that was doing well at the very end, right?
Yeah.
Cool. Well,
Yep.
thanks everyone for being here. The replay will be here. And is there anything else you want to share that you think would be helpful
Nope.
for the audience, for anyone lingering?
Nope. That's it. Good to see everybody. A lot of clients on the call too. So it's good to see you guys. Thanks for joining.
Cool. See you. Bye.
Thanks, Frank. See you.